Hello and welcome. I'm Jo Grimwood. This is Property Question Time, the show where you get to help create the content by posing questions to our panel of property experts. And today I'm joined by three fabulous gentlemen who know their stuff in the property industry. We have Paul Mahoney, who is the MD of Nova Financial Group. Welcome to you, Paul. Evan Maindonald, who's founder and CEO of Melt Homes. Hi, Evan.
Hi.
And also Tony Gimple, who's the founding director of Less Tax for Landlords. Hi, Tony. Fabulous to have your company. We are going to start with a question actually for you, Paul. And your first question is, what are the main points to consider when I consider moving into a buy-to-let?
It's a fairly broad question, so there's lots to consider, but I'll try to bring it down into a couple of minutes. I suppose part of it depends on what you're looking to achieve. There's a range of different things that you can achieve from investing in buy-to-let, and depending on your goals, you should be doing different things and following different strategies. But very broadly, is when it comes to selecting a location, generally you want to be looking for depth. And what I mean by depth is strong tenant demand and large tenant pools, a broad range of industries and therefore employment, given that's one of the main reasons that any of us live anywhere, is living relatively close to work. And if you have diversity in those things, then you can be relatively confident that there'll be sustained demand regardless of the state of the economy. Facilities, amenities, infrastructure are all very important as well, because again, reasons for people to live there. That will generally result in better socioeconomic levels and lower vacancy rates. So if you have confidence in the depth and all of those different factors, then you can have confidence that your property will rent well and it will sell well. But if you're looking at leveraged buy-to-let, the renting side is probably the more important factor to consider, because property prices will fluctuate. Generally they've fluctuated upwards, but at times they will fall. And it doesn't really matter if the price of your property falls, so long as you're not selling at that point in time. Yeah. If your property's rented though, you're safe. If it's not rented, then you've got this extra expense that you need to support, and that can result in you either losing the property or losing a portfolio of properties if you can't afford to support that cost. So making sure you have depth in all of those areas will give confidence that you're in a safe position.
Fabulous. There's also, I suppose, the potential of housing association, maybe getting them to take on your rental, as that tends to be, would you say, on the safer side of things for renting?
I wouldn't say so, because generally they'd be in areas that aren't all that desirable. Housing associations don't tend to operate in highly desirable areas, and desirability is very important. You need to make sure that you're attracting the right sort of person to your property. And if you're relying solely on a housing association taking on board, then you are limiting your target market there. Obviously, a range of other things to consider is all the changes recently in buy-to-let. So there was Section 24, which refers to the tax deductibility or lack thereof of mortgage interest, stamp duty premium, and change with regards to mortgage affordability, which are all fairly complex for an individual to understand. So there is a very broad range of things to get your head around when it comes to investing in buy-to-let, and it's certainly worth seeking professional advice to do that.
Fabulous. And make sure there's a Waitrose nearby. Ideally.
The Waitrose effect, yeah.
Fabulous. And talking of Section 24, we've actually got a question for you, Tony, sort of pertaining to that. With the majority of high street accountants not being able to offer any solutions to Section 24 other than to incorporate and not really wanting to give advice for which they might be held liable, are there firms out there who are prepared and have insurance for example, to stand by the grey areas when it comes to surviving the landlord tax attacks?
I suppose the short answer is yes. But we say grey areas, there isn't a unified tax system. And you get knock-on effects where one ruling can have effect in other places. So law of unintended consequences by legislatures and tax understanding. It's really important, whoever you go to, that they have got proven experience in working in the round with tax affairs. Where something is a grey area, they need to be very sure of their facts and be able to stand by it. And that also means having in place good quality professional indemnity insurance, which will effectively put the client back to the day before they sought advice. And that would include things like paying for fees, any refund of original fees, and fines and penalties. So if you've got a firm which has got real experience in the market, and has the indemnity insurance to back it up, then yes, there are firms out there who will cover the grey areas.
Okay, that's fabulous. Thank you. Now, for any of our viewers that are watching who don't know what we're talking about when we're mentioning Section 24, could you actually just elaborate for me on that?
So Section 24 refers to the recent changes with regards to the way that buy-to-let mortgage interest is treated from a tax perspective. It's quite confusing in the way that it's written, because it says that it's being phased in, and by 2020 mortgages will no longer be tax deductible. That's the way it's written, which is very confusing because you still receive a tax credit at 20%. So the effective effective outcome is that it's deductible at 20%, which means, for example, a common misconception is if you're a basic rate taxpayer and your employment income plus your property income is less than 45 grand, you're not affected whatsoever. And a lot of people think that they will be, but if that's the scenario, then they won't be. But for those that are higher rate taxpayers, they will be. They still are able to effectively deduct some mortgage interest, but it's as a tax credit, which is at 20%, rather than their own tax rate, which is 40%. So, as I say, it sounds confusing, and it is, but it's the effective outcome isn't as confusing as it sounds.
Sure.
The outcome is you will be worse off. It is a lot more complex than even that, and effectively by treating rental income gross, it can significantly increase an individual's tax bill. If you take a basic rate taxpayer, still in employment, but with not a huge amount in rental income, before Section 24, they'd have probably paid less than £6,000 a year in tax in total. By the time Section 24 comes fully into effect, 2021, they are going to be paying double that in tax, simply because tax credit or nay, how the calculation is done. For somebody who's an advance rate taxpayer, and just say purely from property that they no longer have to work, they'll see their tax bill rise to over £50,000.
Right.
When the changes come in. It can push basic rate taxpayers into higher rate tax, it can push higher rate taxpayers into advanced rate tax, and on.
The net impact really is that it makes it more expensive to own a buy-to-let property with a mortgage.
Yeah.
If it's unencumbered, you're in a different situation because there was no mortgage interest to deduct in the first place. But if you're going to own buy-to-let property, it's much more tax efficient now to own it in a limited company vehicle.
Yes.
And
This is
so-
something that's come up a lot actually in past programmes. I think it's definitely something to look into, isn't it?
Absolutely,
Yeah.
yeah.
Okay, so question for you, Evan. I currently own one flat with a long-term tenant of 3 years, and I'm looking to either buy a second property which I will live in, or to sell the existing property and buy another to live in. I'm looking for advice on the advantages and disadvantages of each option, kind of retroactive to what we were just talking about to a certain extent, isn't it?
Yeah, absolutely. So let's start with one option, which is sell your existing property and buy another. The advantage of doing that is that you'll avoid paying the additional stamp duty on the new property that you're buying. Mm-hmm. So that additional stamp duty is 3% on whatever on top of whatever the stamp duty rate for the property would have already been. And so if you can avoid that, then you're saving some money. The disadvantage clearly of selling the buy-to-let property is that you'll end up with only one property instead of two. So you'll miss out on a future investment opportunity. If you would really like to keep the current property, the best way to do it would be to set up a limited company, put the buy-to-let property into a limited company, and then buy another property.
It only gets around the stamp duty, it creates a whole shed load of other problems. It's one of the most tax inefficient ways to do it.
It's most tax inefficient, but you can deduct your mortgage interest against your corporation tax. So I think it depends on your...
But then you're exposing yourself to there's 7 different taxes in a limited company. You've got the problem of getting it in, restricted panel of mortgage lenders, you're locked in.
Yeah, I mean, it's interesting. I think it depends on how long-term your objectives are. I have put properties into limited companies for the last 20 years, and I put them in there and I keep them in there. It's very tax efficient if you do it, if you're doing it for the long term.
If you don't need income. You're never going to need income, and you don't
Well,
mind paying 40% inheritance tax when all the kids do when you fall off your perch.
It depends how you take your income out of the company as well. I think that's another question. But certainly, owning buy-to-let properties within a limited company vehicle, you're going to pay less tax than you do, or the company will end up paying less tax than you do when you're owning it in a personal name. That's my point.
Until you take the money out.
Until you come to the point when you take the money out, but that might be a long way down the road. So over that period of time, you've got the opportunity to build up a large portfolio of property inside the limited company. That's the approach that I take, but others may take different ones.
So on that note, we've got a bit of a lively debate going on, some different opinions of what to look at, which is why we're here, of course, and we are going to throw to a break. I will be back, and our panel of experts will be back with lots more questions when we return. Hello and welcome back to Property Question Time. I'm Jo Grimwood. I'm joined today by a panel of experts, Paul Mahoney, Evan Maindonald and Tony Gimple. Welcome back, gents. Now we're going to start with a golden nugget from you, Tony, I believe.
Okay. Golden nugget. Base your investment decisions on the investment, not its tax treatment. The goal is to get as wealthy as you choose to be, as prepared to work hard enough to be. So don't let the tax tail wag the planning dog. Decide what makes a good investment, property, equities, and within either sector, the right balance and diversification. Better to have the money and pay tax than pay no tax and not have the money in the first place.
Yeah. And as we were talking before about high-level investors, I mean, the fact is the amount that, okay, the tax is going to be more, but they're still taking in a lot of money in investment interest every year. So it's in a material.
If the top number is big enough, you can make a decision as to how much tax you want to pay.
Fabulous. Okay, thank you. Evan, question for you. I'm hoping to get some objective help and advice. We've just put our flat back on the market for the third time in 18 months as we're struggling to sell it, and I'm starting to lose the will. We took it off the market whilst having a baby, but we do really need to move now for more space, and we'd like to be closer to our families who are both quite far away at the moment. Any advice on what we can do to improve viewings and get more people around? That must be frustrating.
Okay, absolutely is. That's a very frustrating situation. There's a problem, and you need to find out what the problem is. Without knowing more about the situation, it's very difficult for me to say precisely what the problem is. But it could be one of a number of things. It could be the price. It could be the way that the property is presented, either the way that it's presented in terms of the photographs that are being shown online. It could be the way that the property is presented when people come to view it. It may be that you're perhaps not seeing that the house could be in maybe a slightly tidier state. Really, to get buyers' interest, you need to set the home out like a show home. So you may need to make some compromises to make the place look a bit better. My advice would be get a couple of new agents around, ones that, not the one that's selling your house at the moment, and ask them for their honest opinion on the situation, why it's not selling. Ask them what they see in either the listing or the presentation of the property or the price. Ask them what price it needs to be put on at to sell. Estate agents have a habit sometimes of telling people that their property will sell for more than it really will, because the estate agent that gives the highest valuation often gets the business. The fact is that at the end of the day, the price is determined by the market more than the estate agent, and so you really need to get a very honest opinion on what the current problem is from somebody who knows the market. Another couple of ideas. Ask your current agent for some feedback from people who have either talked about going to look at the property, or that they've talked to the property about, or who've been to see the property. If you can get some buyer feedback, that may also be useful input to the situation. And finally, another thought: get a friend, somebody who will be independent-minded about the situation, to take a look at the listing, to take a look at the property. Ask them for their thoughts. I think if you combine all of those things together, it'll give you a fairly good idea of what the problem is. And just one final thought: time of year can have a huge effect on the number of viewings and visits that a property will get. So a great time of year to sell a property, bizarrely, is over the Christmas period. People will go and have Christmas with their families. they'll have a lot of time to think about what they're doing, and in January they'll come back and they won't necessarily be that busy at work. It's one of the best times to be selling a property, is in that start of the year. In the summer, you might think that's a good time to sell property. Often July and August, June, July, August isn't a great time to sell property because people are away on holiday. When they've come back from their holidays, a little bit later in the year, they tend to be more in the mode of looking for property. December, the beginning of December is not a great time to sell property because people are thinking about what they're going to be doing for Christmas. So think about the timing of the year. That may have an effect, but I think probably the fundamental problems are whatever the issue is with the listing or the price or the presentation of the property that is a barrier for buyers.
Absolutely. And you mentioned friends. I mean, certainly if you have friends that are interior decorators or anyone with that kind of artistic eye too that could help you stage your house, that would always be a benefit.
Absolutely. That presentation makes all the difference. You need to put the sizzle on the property. If a property is untidy when people come around, they'll automatically devalue it. If there are problems with the property, maybe just even cosmetic problems, perhaps it needs a lick of paint, perhaps the garden's not very tidy, those little things make a big difference. People will discount the value of the property because they think that it's a problem that they're going to have to deal with when they buy it.
Absolutely. Brilliant.
It's one of the rare occasions when you're selling the sizzle and the bacon.
Yeah, exactly. Exactly. Yeah.
And also they did mention that they just had a baby, so I can imagine there might be some children's toys scattered around and, you know, it makes a difference, doesn't it?
Now, it is difficult to manage that stuff, obviously, when
course.
you're living in the property, but, you know, another option is if you really are struggling to sell it, and if the market's flat where you are at the moment, I know the market in London has been very flat for the last couple of years, or particular parts of the London market have been. An option to think about might be just to rent somewhere where for a couple of years, wait till the market recovers, and then put your property back on the market then.
Yeah, absolutely.
Interesting, we've got landlord clients who no longer own their own home. Every penny is invested in the portfolio and they become a tenant in their own right.
Yeah.
All right, they're spending fortunes in rent, but they're going to live in some really nice places.
Yes,
Yeah,
I've heard that too.
it gives you flexibility.
Well, especially in London, it's cheaper to rent than it
It
to
is,
buy.
yeah.
You know, yields are low.
Yeah.
So.
Okay, on to you, Paul. I'm a home owner now. Should I invest in other properties for income or for growth?
The answer to that question depends on where they are in life, really. They mentioned they're a homeowner. That might indicate they don't yet have any buy-to-lets. If that's the case, then it always needs to be a bit of a mixture of both, regardless, because if you're investing for growth, you still need income to support expenses and the debt. But for someone who is looking to create wealth, I'd certainly say that growth is the more important type of return. And the reason for that is you're generally starting off from a small base. So if you invest solely for income, well, the only way you're going to grow that income is by adding more cash. Yes. Or more equity or more assets, whatever. And that's a very slow way of building income. You know, an example, let's say you've got 50 grand and you invest it solely for income and you get a 10% yield, well, that's only 5 grand. Mm-hmm. If your end goal is to have 50 grand a year, the only way you're ever going to do that solely from focusing on income is to save 10 lots of 50 grand. That's going to take most people a very, very long time. If you take that same 50 grand and invest it into a £200,000 property with a 75% mortgage, and that property doubles in value, well, all of a sudden your 50 is worth 250. If you do that 4 times, your 50 is worth $1 million. And that's going to, on a 5% yield, that'll give you the 50 you need per annum. So it's about what stage of life you're at, really. If you're looking to create wealth, then growth should be the focus whilst maintaining expenses through income. If you have an asset base and you're looking to store wealth, then income is most important. Obviously, different types of properties in different locations give those two things in different weightings.
Great. Does anyone have anything to add to that?
It's probably worth saying that it might depend on your geographical location as well. Most people who buy a property as an investment will want to have it fairly close to them. So there is generally a trade-off between capital growth and rental yield on a property. So if you live in London and you're buying a property in London, you're generally going to have a much lower rental yield than if you bought somewhere like Birmingham or Manchester, somewhere further away from London. But the trade-off is that in those places that you'll probably see less capital growth than you will in London. So you need to think about the proximity and the manageability of a property. Generally, it needs to be fairly close to you for you to be able to manage it properly. And that might, to some extent, drive your decision about those trade-offs.
And that holds particularly true if you're starting out trying to create capital. before you instruct anybody else to manage properties on your behalf, you need to understand what it takes to manage a property yourself.
Yeah.
Yeah, I couldn't agree more. We manage our own properties. I have a guy that works for me that manages our portfolio of investment properties. We have about 50 investment properties. And we've tried using managing agents in the past. It's never worked particularly well. Sometimes it's worked okay. Sometimes it's worked appallingly badly. But it's never been as good as managing them ourselves.
Question for you, Tony. I'm being advised that the best way to get around inheritance tax is to put my properties in a trust. Is that true?
No. Putting property into a trust, well, putting most things into a trust these days is not as tax efficient as it used to be.
Right.
If you're putting buy-to-let properties into a trust, everything over £325,000 will be taxed at 20% immediate charge to IHT, 6% every 10 years on the growth, and there's an exit charge when it passes to the beneficiaries. Income would have to go to the trust, and that will be taxed at 45%. So there are a whole load of reasons why you would not put your buy-to-let properties into trust simply to mitigate inheritance tax.
Right.
And you should never ever put your principal private residence into trust, because that creates more difficulties than we've got time to discuss and leaves you exposed not just to tax but what happens in other people's lives. And if you've got a mortgage, I think there's one lender in the UK who will lend to trusts, because it's very difficult for them to perfect the security and get the asset back if all goes wrong.
Right, okay, thank you very much, great answer. Fabulous, thank you gentlemen. This is all we have time for today at Property Question Time. But if you have a question for our panel of experts and you'd like to get involved, please go ahead and drop us an email, info@property-tv.co.uk. You can also log your request on the website. I look forward to seeing you next time. I'm Jo Grimwood. Bye for now.